The stock market just hit all-time highs. Again, the Dow crossed 49,000 for the first time in history. The S&P 500 closed at record levels. The Nasdaq is climbing. Money is being made. Fortunes are being built. Wealth is being created right now, today, this very moment. And you're watching from the sidelines. You're sitting in cash. You're waiting. You're hesitating. You're making excuses. And while you wait, you're getting poorer. I'm going to tell you exactly why you're not investing, even though the market is screaming at you to get in. I'm going to destroy every excuse you're using, and I'm going to give you the exact playbook to stop being a spectator and start being a participant in the greatest wealth creation machine in human history, because that's what the stock market is, a wealth creation machine. And you're voluntarily staying out of it. Before we go any further, if you're serious about building wealth, if you're tired of watching everyone else make money, while you sit on the sidelines, subscribe right now. We're building a community of people who take action, people who understand that waiting is losing, people who get in the game instead of watching it. Hit that button. Let's go. Here's what just happened. The S&P 500 returned 17.9% in 2025, not 2%, not 5%, almost 18%. If you had $100,000 invested, you made $1,700. You did nothing. The market did the work. You woke up, went about your life, and your money grew by nearly 20 grand. That's the power of being invested. That's what happens when you participate. But you didn't participate, did you? You were sitting in cash earning 3% or 4% in a savings account. So your $100,000 made you maybe $3,500. Meanwhile, inflation ran at 5% or higher. So in real terms, you lost money. You went backwards. While invested people made 18%, you lost purchasing power. That's the cost of sitting out. That's what fear costs you. And now the market's at all-time highs, and you're even more scared. You're thinking it's too high. It's going to crash. I should wait for a pullback. I missed it. It's too late. These are the thoughts running through your head, and these thoughts are keeping you broke. Every single one of them is a wealth killer. Let me explain why. First excuse, the market's too high. This is the dumbest thing you can say about the stock market. Too high compared to what? The market has been hitting all-time highs for over a century. That's what markets do. They go up over time. Every all-time high becomes the starting point for the next all-time high. In 1995, the market was at all-time highs. People said it's too high. It then doubled. In 2013, all-time highs. People said too high. It doubled again. In 2019, all-time highs. Same story. It kept going up. You know what the market was in 1980? 100. You know what it is now? Almost 7,000. That's 70x. 70 times. Every single point along that journey, someone said it's too high. And everyone who listened to that person stayed poor. Everyone who ignored that person and invested got wealthy. Which group do you want to be in? Here's what you don't understand. The market doesn't care that it's at all-time highs. Companies are still making money. Earnings are still growing. AI is revolutionizing productivity. Corporate profits are expanding. The economy is growing. All the fundamentals that drive stock prices are still intact. The market's not high because of speculation. It's high because companies are worth more than they used to be. That's called growth. That's called value creation. JP Morgan is predicting double-digit gains for 2026, 8% to 12% more growth. The AI supercycle is fueling record capital expenditure. Corporate earnings are accelerating. The Fed is cutting rates. These are bullish conditions. These are wealth-building conditions. And you're sitting out because you think it's too high? That's not wisdom. That's cowardice. Second excuse, I'm waiting for a crash. This is my favorite one, because it reveals everything about your mentality. You're waiting for a crash so you can buy cheap. Sounds smart, right? It's not. It's the broke person's fantasy. Let me tell you why. When was the last crash? 2020, COVID. The market dropped 34% in a month. Brutal, scary. Everyone panicked. And you know what happened to the people who were waiting for that crash to buy? They didn't buy. They were too scared. The crash they waited for finally came and they froze. Because when the crash actually happens, it doesn't feel like an opportunity. It feels like the end of the world. You don't buy, you hide. And even if you did buy during that crash, which you probably didn't, you would have bought at, let's say, S&P 2,200. Great. You timed it perfectly. You're a genius. But if you had just bought in early 2019 at S&P 2,800 and held through the crash, you'd be better off today anyway. Because time in the market beats timing the market every single time. But here's the real problem with waiting for a crash. While you wait, you miss gains. The market went up 18% last year. You missed it. It's up another 1.2% in January already. You're missing it. Even if the market crashes 20% tomorrow, which it won't, you'd need it to crash more than 20% just to break even with where you could have bought last year. You're not being smart, you're being stupid, you're guaranteeing that you miss gains in exchange for maybe, possibly if you're lucky, buying a little cheaper someday. That's a terrible trade. Third excuse, I don't have enough money to invest. This is just a lie you tell yourself. You have money. You just spend it on garbage. You spend it on things that keep you poor instead of things that make you rich. You have money for streaming services you don't watch. You have money for eating out 5 times a week. You have money for a car payment on a vehicle that loses value every day. You have money. You're just allocating it wrong. You don't need a lot of money to start investing. You need any money. $100, $500, $1,000, whatever you can scrape together, you start with that. You buy index funds, you buy dividend stocks, you get in the game, then you add more every month, $100 a month, $500 a month, whatever you can manage, you build it over time. That's how everyone starts. Nobody starts rich. Everyone starts small and compounds. But you're not starting at all. You're making excuses about not having enough. Meanwhile, the market's going up without you. Every month you wait, you miss gains. Every year you wait, you miss compounding. You're not waiting until you have more money. You're waiting until you're too old to benefit from it. Fourth excuse, I don't know what to buy. This is laziness disguised as ignorance. You don't need to know what to buy. You buy the market. You buy an S&P 500 index fund. You buy a total market ETF. You own a piece of the 500 biggest companies in America. Apple, Microsoft, Nvidia, Amazon, Google, all of them. One purchase, done. You don't need to pick individual stocks. You don't need to be a genius. You just need to own the market. And if you want dividends, you buy a dividend ETF. One fund that holds 50 or 100 dividend-paying companies. You get diversification, you get income, you get growth. It's not complicated. You're making it complicated because complicated gives you an excuse not to act. Simple truth, you're scared, and fear is keeping you broke. Fifth excuse, and this is the one that really bothers me. The market's risky. I could lose money. Yes, you could. That's called investing. There's risk. But you know what's riskier? Sitting in cash and watching inflation destroy your purchasing power. That's guaranteed loss. At least with the market, you have upside. You have the potential to build wealth. With cash, you have the certainty of going backwards. And let's talk about risk. The S&P 500 has returned an average of 10% per year for the last century. Through world wars, through depressions, through recessions, through crashes, through everything, 10% average annual return. That's not risky. That's one of the most reliable wealth building tools in existence. You know what's risky? Having one income stream, having no investments, being completely dependent on a paycheck that could disappear tomorrow. That's risky. Here's what kills me. You're worried about the risk of investing, but you're not worried about the risk of not investing. You're not worried about being 65 years old and broke. You're not worried about working until you die. You're not worried about never retiring. Those are real risks. Those are catastrophic risks. And those are the risks you're taking right now by staying out of the market. Let me show you the math of what you're missing. The market went up 17.9% in 2025. Let's say you had $50,000 to invest but didn't. You missed $950 in gains. 1 year, almost $9,000 just evaporated because you were scared. Now projections for 2026 are another 8% to 12% growth. Let's be conservative and say 8%. That's another $4,000 in missed gains on that same $50,000. 2 years, you've missed almost $13,000. And that's if you invest now. If you wait another year, you miss even more. Over 10 years, missing these kinds of returns costs you 6 figures. Easily. That's not a hypothetical. That's math. That's the real cost of sitting on the sidelines. That's what fear costs. That's what waiting costs. And you're paying that price right now. Now let me address what you're really afraid of. You're afraid of buying at the top. You're afraid the market will crash right after you invest. You're afraid you'll lose money and feel stupid. I get it. That fear is real. But that fear is also irrelevant because you're not investing for next month. You're investing for the next 10, 20, 30 years. And over those time frames, it doesn't matter when you bought. Let me give you the worst case scenario. You invest today. The market crashes 30% next month. Brutal. Your $50,000 becomes $35,000. You lost $15,000 on paper. Feels terrible, but if you hold for 5 years historically, the market recovers and goes higher. Your $35,000 becomes $60,000. You made money. Even in the worst case scenario, if you hold long enough, you win. But here's what actually happens most of the time. You invest. The market keeps going up. You make money. Then there's a correction. 5%, 10%, 15%. You panic. You sell. You lock in losses. And then the market recovers without you. That's the real risk, not market crashes, your behavior, your panic, your inability to hold through volatility. This is why you need to change your mentality. You're not buying stocks. You're buying pieces of businesses, real companies that make real products and real profits. When the market drops, those companies don't disappear. They keep operating, they keep earning, they keep growing. The price might fluctuate, but the underlying value is still there. If you understand that, you can hold through anything. Here's what the wealthy understand that you don't. Market volatility is not a bug. It's a feature. It's the price you pay for returns. You want 10% average annual returns, you accept 20% or 30% swings along the way. That's the deal. If you can't handle volatility, you don't get the returns. Simple as that. And if you can't handle volatility, you stay broke. Because safe investments don't build wealth. They preserve poverty. So here's what you do today, right now, before you do anything else. You open a brokerage account if you don't have one. Fidelity, Vanguard, Charles Schwab, any of them. Takes 10 minutes. Then you deposit money, however much you can. $100, $1,000, $10,000, whatever. You transfer it from your bank account to your brokerage account. Then you buy an S&P 500 index fund, ticker symbol SPY or VOO. One click, done, you're invested. You're in the game. Don't overthink it. Don't research for 6 months. Don't wait for the perfect entry point. Just buy. Get in. Because every day you wait is a day you miss gains. And those gains compound. The difference between starting today and starting next year could be tens of thousands of dollars over your lifetime. That's not hyperbole, that's compound interest. And once you're in, you stay in. You don't panic sell during corrections. You don't try to time the market. You don't check your account every day and freak out over short-term moves. You hold. You add more every month. You let time and compounding do the work. That's the strategy. It's boring, it's simple, and it works. Now let me address the people who are going to say, but what about valuations? What about the Buffett indicator? What about price to earnings ratios? These are the people who have been saying the market's overvalued for 5 years while it doubled. These are the people who will say the market's overvalued for the next 5 years while it doubles again. Don't be those people. Yes, valuations are high by historical standards. Bank of America said the S&P 500 has never been more expensive on certain metrics. Okay? So what? Valuations can stay high or go higher for years, especially in an environment where AI is revolutionizing productivity and corporate earnings are accelerating. High valuations become justified when earnings grow into them, and earnings are growing. You know what else was expensive? The market in 2013. It then tripled. The market in 1995, it then quadrupled. High valuations are not a sell signal. They're a sign that the market expects future growth. And historically, the market's been right about that. So unless you have better information than the entire market, you invest and you hold. And for the people saying AI spending is too high, companies are overspending, this is going to end badly, maybe. Maybe companies are overspending on AI. Maybe it doesn't pay off the way they expect. But you know what? I'd rather bet with the companies spending $80 billion on AI than against them. I'd rather bet on Nvidia, Microsoft, Amazon, Google investing in the future than bet on some analysts saying they're wrong. These companies have the smartest people and the best information. I'm betting with them, not against them. Here's the reality. There are always reasons not to invest. Always. The market's too high. Recession's coming. War in the Middle East. Political uncertainty. Trade tensions. Whatever. There's always something. And if you wait for all the risks to disappear before you invest, you will never invest. Because risks never disappear. They just change form. Successful investors understand this. They don't wait for perfect conditions. They invest despite imperfect conditions. They understand that risk is always present, and that's okay. Because over time, the market goes up. Over time, companies grow. Over time, wealth is built. But only if you're invested. Only if you're participating. Let me tell you what's going to happen if you don't invest now. The market's going to keep going up. 2026, another 8% or 10%. 2027, another 10%. 2028, more gains. And you're going to keep watching, keep waiting, keep making excuses. And in 5 years, you're going to look back and realize you missed a 50% or 60% gain. And that realization is going to hurt more than any market correction ever could. Or you could get in now, today, And even if the market drops 20% next year, which again, it probably won't, you'll be positioned to benefit from the recovery and all the gains that come after. You'll be in the game, you'll be building wealth, you'll be doing what wealthy people do. So here's my challenge to you. Stop making excuses. Stop waiting for perfect conditions. Stop being paralyzed by fear. Take whatever money you can invest, even if it's just $100, and put it in the market today. Buy an index fund. Get started. Then commit to adding more every single month. Automate it, make it a habit, build your position over time. Because here's the truth. The best time to invest was 10 years ago. The second best time is today. Not tomorrow, not next week, not after the next correction. Today, right now. The market's not going to wait for you to feel comfortable. Wealth is being created right now. You can either participate or watch. Your choice. And if this message landed with you, if you realize you've been making excuses and it's time to take action, I need you to do 3 things. First, subscribe to this channel. We're building a community of people who take action instead of making excuses. People who understand that building wealth requires participation, not speculation. Second, drop a comment and tell me this is the day you start investing. Write it down, commit publicly. That makes you more likely to follow through. Third, share this video with someone who needs to hear it. Someone sitting on cash. Someone waiting for perfect conditions, someone who needs a wake-up call. This channel exists to push you into action, to destroy your excuses, to show you that building wealth is not complicated, it just requires courage. The courage to get in the game, the courage to hold through volatility, the courage to stay invested when everyone else is panicking. That's how you build wealth. That's how you win. The market hit all-time highs. Money is being made. Fortunes are being built. Are you participating or are you watching? Because watching doesn't pay. Action pays. Investment pays. Time in the market pays. So stop watching and start doing. Get in the game. Build your wealth. That's how you win. Now go make it happen.